Hey everybody, it's Shannon from Alphatrends.net. Today's Friday, the 13th of October, 2023. Hope you had a good week of trading. It was a mixed bag for the markets. S&P and NASDAQ finished with a slight gain. Russell 2000 continues to be a dog, down 2.3% for the year, 17% off the high and just off its lows. Semiconductors had a tough week, and that's typically what leads us. So still, though, a hefty 46% year-to-date gain. And down here, you can see that bonds rallied, oil rallied. So let's take a look at these charts and make some sense of it. Here's the S&P 500 daily on the left, as always, and on the right is a 30-minute time frame. What we're looking at here on the left first is the daily with the declining 20-day moving average. That will continue to decline at least for the next 2 days as we get rid of this data. And the 50-day moving average, we're going to get rid of this data. So we're below the declining 50-day moving average. We're at the anchor from this prior low, and that's exactly where the sellers showed up this week. Coming into this week, we looked at this market and thought, where has it come from? As always, we want to say it's expended a lot of energy getting into this area. Where does it have the potential to go before it's likely to encounter supply? Now, it made it up through this level, but didn't hold above that level for the week. So going into next week, it paints a little bit more cautious picture here. The market is below the 5-day moving average, and that 5-day moving average is starting to flatten out. So the important levels that I'm looking at are the anchored volume weighted average price from this low here of the month and the month-to-date anchor. So if it comes into this zone, ideally I'd like to see that hold, and then it creates the higher low from which maybe a springboard could come, and we continue to see some strength here into the end of the year. The NASDAQ found sellers right up against that trend line. And as we look at all of these things, the 20-day moving average, the 50-day moving average, the anchored volume weighted average price from that peak, they're all just levels of interest where we say, this is where we want to look to see if the buyers are slowing down and the sellers are taking control. They're not necessarily an action point. So we look at it and say, okay, we're at that level right here. That's this. Was there a reason to sell at that point? Not that I could see. Now, of course, we since then have made a pattern of lower highs and lower lows right here, and we're below the 5-day moving average. So next week, I would expect a little bit more consolidation, perhaps down in towards this zone. Maybe we run into the anchor off of this low, and then that gets this 20-day moving average kind of flattened out. And then the 50-day moving average will start to rise as well. So I think the bullish scenario is we do something like this, and then mid to late next week, we start to rally once again. It's looking like it has that potential to do so. I'm not ready to be a buyer yet because, again, on the shorter term time frame, the pattern here is we have this high, we have a lower high, we have another lower high, we have this low, and we have a lower low. So I don't want to buy the pullbacks. I want to buy strength after the pullback. Russell 2000 has told us over and over again, don't buy this pullback in here. It isn't a pullback. It's a downtrend, and we're continue to be down at the bottom end of this range that we've been in for the year. Some people expressed concern that we have a so-called death cross. That's when the 50-day moving average crosses down through the 200-day moving average. I will say the last one we saw was right here. That didn't really, if you look at the 1 month, 3 month returns, you would say that was a bullish event. The one prior to that was up in here. Now the difference is, this was after a big rally. The one prior to that was as we were breaking down from COVID. So I think you have to look at the so-called death cross as something is just really kind of noise, especially from an intermediate term standpoint. Now's not the time to get bearish after this market is well off of these highs it's made this year. I think I said 13% or so. Short-term momentum remains lower. It's just a waste of time, in my opinion, to look to be a buyer for anything more than a bounce. As I was mentioning to subscribers this week, if you got long, this is where your stop should have been. This was the higher low, and we broke below that higher low right here. That was the reason to get out. And if you were if you were involved because of this rally right here, that was your cue to get out. Next week, I see, basically it continues to be a waste of time. I'm really not interested in it. Semiconductors rallied just as the NASDAQ did, right into this trend line off of in this case, the all-time high, and then the August high, and now again, here's our October high. So where does that leave us? Well, we've got a little bit of downward momentum here in the near term. It might have gotten a little bit overdone in here today, but if we get a bounce up towards this level, look for the potential of resistance near that 150 area. It is this little band of support right here. It is the 5-day moving average, and we would see a lower high. If that happens and we start to break down further from there, look for these levels, and I think perhaps the bigger level would be the anchor off of the last month's September's low, and that would bring us down in towards this zone right in here. So it doesn't look like a disaster is about to happen. Ideally, on the daily time frame, we see, just as I'm hoping for the NASDAQ and S&P, that we just kind of pull back a little bit, build some strength, and create a launching pad. This market ran quickly into a level where it found supply. Now let's wait patiently for the buyers to emerge and show that they can take it higher once again. That way, if we're buying on strength over here, we have a logical place to set our stop underneath whatever this higher low is. Let the institutions do the dirty work of battling out and creating those levels of support. There's no reason to be involved early. Biotechs have been a great example of that. All year, these guys, well, not all year, because they were the strongest group in January and February. If you recall, we had a really big rally, and this was maybe going to be our leader, but we saw a lower high over here, and then we fell back down to the bottom end of that range, broke below it, and that continues to be a sticking point along with the declining 20-day moving average. It's still in a downtrend. It's guilty till proven innocent. The only reason to buy it is to offset winners you have somewhere else if you're looking for tax losses. I don't buy downtrends. This isn't a downtrend on the daily time frame. It's in a downtrend on the weekly time frame. It's in a downtrend on the short-term time frame. Of course, it could turn, and just because I'm talking so negatively about it, it probably turns next week, and then some guy's going to say, hey, Brian, look how stupid you are. That's not the point. The point is we want to trade with trends. These are guilty till proven innocent. Of course, you can get these bounces. I saw it recently. You know, people were saying, "Hey, Square, look at that. That's the low. Look at that big bounce in there." And you see the same thing with PayPal. People get excited about these they're big rallies. Okay, call them what they are, but they're big rallies in downtrends. Go back and look at the video I had about the declining 200-day moving average. We spoke about PayPal, and that was over in here. And now here we are at a fresh new low in PayPal. It's still a piece of garbage. It'll probably rally a little bit and then continue to drift lower. And if it doesn't drift lower, then it's going to turn sideways. If they don't scare you out, they'll typically wear you out. Financial stocks, they began the earnings season today, and today they were up 6 pennies. That is really not much conviction after a lot of earnings, and nor should there be conviction here, because we came right up to the level that we've been discussing, which is this prior band of support in here, which turned resistance and continues to provide resistance. It's the anchored volume weighted average price off of this high in September. It's the declining 200-day moving average. It's the year-to-date anchored volume weighted average price, that thick blue line in there. It is finding supply. Support broken tends to act as resistance. That's what you're seeing here. Now, is it ready for a short? Maybe next week it'll be ready for a short if we get trapped underneath this 5-day moving average. It can still recover, but if it starts to look like this, I would be looking at these and saying, let's monitor it from the anchor from this low right here, and you can see how it touched it here, and then again today. So that's clearly going to be important. If it starts to take that out, then what you would want to do, I think, is look for short opportunities with a stop above one of these higher lows, if that is in fact a higher low, a lower high rather. I'm sorry. And in fact, if it takes out one of those highs and rallies and gets back above the 5-day moving average, forget about the bearish scenario. But do you want to buy this thing? It's got a declining 50-day moving average, a declining 200-day moving average. Not the type of thing that I want to be a buyer of. Energy names, they've been all over the place. Let's look at oil and try to make some sense of that, because here we see oil, crude, and we saw that it sold off down to the anchored volume weighted average price from that high right there, and then this is where that move began, and that's where we found buyers a week and a half ago. Then on over the weekend, of course, with that war breaking out, it gapped up, and then it came right back down yesterday and tested that level again. So this is clearly an important level for oil. Now the buyers have regained control, and it's actually back above the anchor from this high, meaning the average long from that pullback is now making money. The average short from that pullback is now losing money. So the buyers are in control. It doesn't mean they'll maintain control, but it's their game to lose. So if you're looking at oil, the logical thing to say is if you want to get involved in it long, your stop probably goes underneath this low right here. Let's bring that back to the oil stocks and see that we've just got a mess here. I don't really see much reason to be looking at energy names. They're just too damn choppy. If you look at this high, then this high, this one's lower than that one. This low, well, we had a lower low, and it came right into that 200-day moving average and bounced. But I don't buy at levels of support because we only know support after the fact. And sometimes you get these gaps, and you're left on the sidelines, not being involved. But it's better to be on the sidelines in cash, wishing that you were in, than it is to buy and get involved and then wish you were out if the trend continues. So that'll do it for me. Have a good weekend. Thanks for tuning in, and I'll talk to you again sometime next week.